Now, how this is going to run is yes, I will give some somewhat lengthy introductory remarks, but very much to contextualise and frame up this theme and this Q&A. Our title is Industry Collaboration to Achieve Decarbonisation, What is Required. Fairly innocuous title, but there's really a lot to this, so let's go. What do we mean by industry in this context? Well, certainly that's the mining, minerals and metals sector. For simplicity, we'll refer to it as the mining sector today. But it's also important to recognise the collision that's occurring between the energy and resources sectors. And what do we mean by decarbonisation? Narrowly, it's decarbonising the Scope 1 and 2 emissions of the mining sector, but it's ultimately the more transformational Scope 3 emissions which need to be decarbonised. And more broadly still, there's the decarbonisation of the economy inclusive of this sector, and we need to recognise the enabling role this sector must play to achieve that, and how challenging it's going to be to massively increase the global production of copper, nickel, cobalt, etc., to deliver on the energy transition. And when seen in that wider context, this sector actually stands to be the great winner as the world's energy system moves from being liquids-rich to minerals-intense electrification. So it's little wonder we see the big players in this sector now leaning right in, their investors leaning right in. So I'll spend a bit of time now on collaboration because for me it's a perplexing question actually. When I think about how competitive global markets and value chains have been remarkable at delivering innovation and massive economies of scale over the last few centuries, exponentially more so in the last 30 years. But we seem to be fixated on this term collaboration in the context of the energy transition. Why is that? At one level, it's easy to understand given the failure of governments to deliver the carbon price mechanisms or sufficient signals within those to drive the markets to do their thing. And especially now, given the scale of the challenge and the short time frame to keep anything like 1.5 degrees alive. And of course, the Paris Agreement that finally gave us the much needed and pragmatic pathway for the collaboration of countries on this, though it has by definition fundamentally messed with the functioning of open markets and rendered price signals within jurisdictions to be very much a function of policies of government. And while there's a large amount of capital available to be deployed into this space, and at COP26 we learned that's some $120 trillion, none of that is donor money. It's looking for projects and assets that will clear minimum return on investment hurdles. We can't lose sight of that. So the need is clear, the money is there, but we need a bridge. In part, I think collaboration is referring to the need for action to bridge that gap. We will leave politics out of this discussion today, but I think the role of governments in all of this is inescapable. So that may come up. But what of business strategy? Why is this leading people to focus on collaboration? In the last 2 years, and I've been part of this, we've witnessed widespread future-back thinking by business strategists, working back from a net zero 2050 world, and companies are now racing to position themselves in the face of the opportunities associated with what, on paper at least, will be the largest deployment of human capital, or of capital in human history. But how does that work in the absence of carbon pricing or sufficient signals? Firstly, and I'm in the home straight, firstly, I think there's a belief or assumption that alternative government policies are coming that will drive change, and they are rapidly emerging. But there's also confidence that the sheer scale of this opportunity will drive speculative investment in technology development. And I think we're hearing that outside as we're in here. The fall in the cost of renewables over the last 15 years has been so dramatic to give us some good confidence in technologies coming down cost curves when we lean into this. And when it comes to Scope 1 and 2 emissions today, it's already commercial to deploy renewables for significant decarbonisation in this sector, as was demonstrated by a number of speakers yesterday. But how do you position at least costs for technologies that are still not technically or commercially ready today? This is the nub of it for me. Well, you partner, you leverage the investment of others, and you work together to accelerate. Last point, we'll move to the panellists. There's a broader question of community buy-in and collaboration here, which we just heard about. And I, for one, look forward to coming to an IMARC where the police presence outside is simply to hold back the fans. But I think we've still got a way to go. All right, so to our great panellists, okay, Greg, John, Stuart, Chris, if I may, can you just each in turn, and starting with you, Greg, and working your way to me, just a couple of minutes introducing yourselves again, who you are, but importantly, what's your connection to this theme personally and or of the business you represent?
Yeah, thanks, Taz. So you've heard a few Shell speakers at this event, and so I'll try not to cover any ground that's already been covered, but clearly net zero by 2050 is an enormous challenge, and for Shell, 90% of the emissions are through the consuming the products that we manufacture or produce. So here in Australia, the business I lead, I guess, is very much around putting the building blocks in place for creating more and cleaner energy. And so we have acquired a number of positions, ERM, that gave us 20% of the commercial industrial power market in Australia, Power Shop, a position in residential, two development companies, one in solar and one in wind, that collectively have in excess of 5 gigawatts of renewables in a development pipeline. And of course, we have the largest trading desk for energy in Australia. And it's really that lens we have of integrating power across the value chain with the view to then turning our focus to those 90% of emissions associated with customers, and that ability to move from many of the products that are being consumed today like diesel and moving towards electrons, and doing that cleverly and building those positions across value chain to make that possible. And that's the focus, and it's an uplifting process to take the balance sheet strength of an innovation legacy of a company like Shell and turn it to these new sectors to create a new future, and great to be part of it.
That's great. John?
Thanks. G'day, everyone. My name's John. I'm the head of climate and closure planning with MMG. I am an engineer, but I also have qualifications and experience in the E, the S and the G of ESG, which the last talk covered quite well. For those who are not aware, MMG, we're a mid-tier copper and base metal miner. We're headquartered in Melbourne, but we're majority owned by a Chinese state-owned enterprise called China Minmetals. We also have a minority stock listing on the Hong Kong Stock Exchange. We have operations in Tasmania and Queensland, as well as Peru and the Democratic Republic of the Congo. And my role is about supporting our assets operationally and technically on their decarbonisation journeys. And we've, excuse me, we've just at the start of this year, we've recently announced our climate strategy and our targets. So we have a net zero 2050 target and an interim goal of 40% reduction in scope 1 and 2 by 2030. Based on a 2020 baseline. So we have ambitious targets and lots of work to do in order to achieve those. I'm passionate about this topic because it's important. There's a climate emergency and no one can solve these challenges on their own, and us as a sector can't solve it on our own. So we must collaborate and learn from each other and learn from others in order to get there. And it's doubly important for us in mining, for the whole society to decarbonise. We need many more mines, and there's a large social licence element to that. So we need to ensure that our ESG performance as a whole, not just on decarbonisation, but all of our ESG areas are performing quite well to facilitate that production expansion. And finally, I guess I'm lucky that my company, MMG, is really committed to this, which gives me a platform to collaborate with people, come to places like this, join industry consortia and learn from world experts, and there's many of them here this week, and then share those insights amongst my company down the hill on the operational level, because that's where the work's going to really needs to get done. So yeah, really passionate about the area. Thanks.
Thanks, John. Stuart?
Yes, hi everyone, my name's Stuart Sneyd. My background, I'm a chemical engineer, and I spent a lot of my early career actually playing around with high temperature fluid beds, and bit of a side note, but it was in hydrogen-based direct reduction, which 20 years ago was not such a thing, but is now coming back to be quite a thing as in part of this discussion we're having. So that's sort of interesting for me. But about our company, Metso Outotec, look, we're a business that's been around continuously operating since the late 1800s, and in the mining space. The company's definitely somewhat unique in that we have quite a strong view from the mine to the metals production. So we're involved in a very wide part of the value chain in the mine to metals space across a number of different commodities. So we take quite a broad view of how you would decarbonise the mining value chain up until raw metals production. And we're, as a business, committed to science-based targets of 1.5 degree targets on warming. As mentioned in a previous session here, there's a lot of companies that commit, but what do you actually do practically? I mean, we're very much about, we measure our own scope 1 and 2, we report that, but we also starting to measure the scope 3 emissions. So I think we definitely try to understand our place in the total value chain and we call it our handprint. What's our handprint on the industry? We measure our own footprint, but what's the impact we can make upstream and downstream in the whole business? We are starting to measure that, and we do start to report it as well. So it's not easy. It's about data as well, but also process domain expertise. But anyway, that's sort of our position in the business at the moment.
That's great. Thank you, Chris.
Right. Hi, folks. Chris McLoughlin. My background, and the reason for the joke with Ashley is I started life as an accountant, and we have a running battle with economists. But I'm glad that she's got to cope with that level of uncertainty and not me. I've been with Greenbase since 2014, running with them. Greenbase has been servicing the mining sector since 1998. And as I said at the start, we prepare a lot of the pollutant and greenhouse gas inventories for about 250 mines across Australia and internationally. My real interest in being here is to do myself out of a job. I'm looking forward to the day where we don't count carbon anymore and we'll all achieve net zero. And I do think that the way that we're going to get there fastest and safest is by collaborating together. So really interested to see so many people embracing the collaboration. I've heard the word trust mentioned a lot over the last 3 or 4 days, last couple of days here and couple of days in Perth, and I think that's part of the key to it, is that it's almost if we have to go through the valley of fear first before we get out, and we can then start looking at, okay, the only way we're going to get through it is by trusting people, is by collaborating and doing things jointly together. Thanks, Tom.
Thanks, Chris. So we are going to battle with that noise out there, but I promise to get you more than an hour of time for lunch, so do stick around. Look, we'll launch into the Q&A and delve deeper into this question now of what is required for successful industry collaboration, and we'll come some more to that issue of trust. But let's start on the theme of collaboration for technology development, particularly in the harder to abate end. One of the most electric collaborations I'm seeing is that of BHP, Rio Tinto and Vale's Charge On Innovation Challenge, and a number of others have commented on this, facilitated by FAusIMM, now involving 16 other mining patrons. Now Shell Energy is leading one of the 8 selected consortiums seeking to revolutionise electric haul truck charging. So Greg, can you tell us a bit about why Shell Energy decided to tackle this? And more importantly, perhaps, what, for the audience, what are the principles from a Shell perspective that are key to making a cross-sector collaboration really work?
Yeah, look, it's been a great process, and I think the word collaboration's been mentioned several times already, and it's at the heart of the Charge On process. I mean, you look at mining, and some of the other speakers have mentioned 7% greenhouse gas emissions for scope 1 and 2, and 28% for including scope 3. So mining has a really big impact, and it's very important in underpinning construction and a lot of the manufactured goods. So there is no more important sector to decarbonise, and we have a long history of working with the mining sector. So to participate in Charge On was a fabulous opportunity. And 50% of those emissions, or 40 to 50% of those emissions in mining, are related to mobility related activities. So this opportunity to come up with a concept for electrification of large haul trucks really, I guess, was an opportunity where we saw to integrate technology leadership across a number of areas to find a solution. So our focus in the midst of that, when you looked at thematically the participants and the submissions, was electrification concepts that were tramline or above head electrical lines, charge out of batteries or swap out of batteries, sorry. And then the option that we pursued, which was fast charge of static battery solutions. And we took that approach because we felt that it was the most dynamic. And so the elements that we've put together, and it involved a consortium of 9 different players, which is a real acknowledgement that in this area of innovation, you really do need to find the right partners that bring to the table their expertise. And so the first element was focused on basis of design around microgrids that could apply to a mine site. The second was the robotics of being able to charge and get to vehicles when they are loading and unloading in a manner that maintained the productivity of the mine site. And then the third element was focusing on breakthrough technologies in fast charge batteries. So combining high performance batteries with supercapacitors in a manner that met the challenge associated with having a solution that was less than 17 tonnes, could fit into 23 cubic metres of space within the large-scale dump truck. And the concept that we were able to create would enable discharge at a pace of 400 kilowatt hours in less than 90 seconds. And so creating not just a solution to decarbonise, but a solution to enhance productivity at the same time through collaboration. Of course, the concept is, off the back of selection, is in the lab being developed. Our approach is to move through that phase across 2023 and in parallel agree with miners the framework of pilots that would subsequently follow to test the operability. And then thirdly, do that with the view to scale up. And when you think about collaboration in this manner, what's really important is to get the principles sort of agreed up front for how you're going to collaborate. Because there's tremendous investment required, there's tremendous collaboration access of knowledge that you need. So I think in our consortium we've got 9 parties, but we would work closely with the miner, obviously, and have skin in the game from all parties to handle through that, manage through that FESEX phase in a manner where you also, I think Ashley mentioned before, have a really good understanding of the connections across the value chain such that you get a fit-for-purpose solution. I guess the second element that we think is really important is framing a pilot in a manner where you're really clear about what the milestones will be that would be the threshold to reach that point of inflection where you would then scale up. Because you have to have an eye to building the organisational capability to move from one year to another. And agreeing those milestones up front, I think, is a real key aspect. And then a third aspect, really, when you're in a consortium of 9 parties, somebody has to take the role as project integrator, and that's very much Shell. We see that as a core competence. But understanding how you reward and protect IP in that space in a manner where you genuinely collaborate just means you need to get that value sharing model sorted up front so that the parties can focus on the real deal, which is bringing these wonderful innovations to fruition.
That was an awesome answer, thank you. I think that was of real value to people. John, we just heard from the big end of town and on a major collaboration with the big mining houses. But can you give us MMG sort of mid-tier perspective on how you're approaching industry collaboration? And there are a number to choose from out there internationally. What are the benefits to MMG in joining them?
Sure. So from a mid-tier perspective, firstly, again, we don't have all the answers, so we need to collaborate and work with others to help us go and find those answers. The key challenges we have span, technology, organisational capability, as well as commercial or financial aspects. We're not impeding on production performance, as you mentioned. So for mid-tier miners, we generally don't have the size of the asset portfolio to or procurement pool to influence OEMs directly by ourselves. So there's benefit for us to group together and collectively approach the OEMs, get a better understanding of their timeframes of delivery of low or zero emission vehicles, and then when players like us might be in line to be able to buy one, we don't have the finances for large one-on-one OEM partnerships. So we might be third, fourth, fifth in line after the big guys. So it's important for us to communicate to them our timeframes of decarbonisation, and so that they can then respond to us and we can work together. So we can't do that by ourselves. As I mentioned, with the public announcement of M&G's climate strategy earlier this year and our targets, so we quite quickly undertook a landscape analysis of all the different research consortium partnerships out there, which was, ranged from cooperative research centres with academia and government, 101 OEM engagements, commodity-specific group engagements, and a range of others. And there are heaps out there, and it's just about trying to work out which one's the right fit for us. So we chose 3 or 4 to join, and we spoke about Charge On. That was a fantastic partnership. It was, however, quite narrow in its focus, quite deliberately. Big trucks, big open pit mines. Half of our mines are underground, so that it wasn't really fit for us at the time, and we probably came in too late anyway to participate. But we have spoken to some of the winners of Charge On, and 2 of them actually joined another group we're part of called the Electric Mine Consortium, which some of you heard about yesterday, as I understand. So that's a really a great group with a much broader mandate. So they're not just looking at open pit trucks, they're looking at underground trucks, surface haul, battery storage, mine site electrical infrastructure, skills and capability development too. So it's very broad, and there's a big group of organisations, mainly mid-tiers like us, that we can learn from. And at the panel yesterday, we heard some really inspiring work from particularly Goldfields and also Oz Minerals, doing some fantastic work in that space. There's a great benefit for us to learn from their experiences, as well as Newcrest, South32. They're doing great work too, and that consortium has a knowledge sharing agreement. So we can benefit from trials at other companies' individual mine sites rather than each mine, doing 50 trials at one mine. We can share the results with each other, and that way we can learn faster and get better quicker, and also provide us a bit more confidence in making capital decisions on fleet renewals, etc., and indicating to our OEMs, when our orders are going to be due in the next couple of years, right? So there's a huge benefit there from that Electric Mine Consortium. Another group we're a member of is the Global Mining Guidelines Group, GMG, and they've got a booth out here. So go speak to Heather and the team. They've been around for a long time and a focus on many areas in mining, so not just decarbonisation, but also cybersecurity and sustainability and other aspects. But they run webinars, roundtables, workshops, site visits, etc. And they also public documentation, like good practice guidance and things. They've got a particularly good document on battery electric vehicles in underground mining, which is now in its third volume or third revision, and we've used that to help us, I guess, prepare for the future of those underground vehicles in designing new workshops underground, for instance. So even though we don't have them vehicles yet, we know that in the future we'll know various amounts of space underground and what's required. So we're making sure our new developments are future ready or net zero ready in the future. Another group is the International Council on Mining and Metals. A lot of you have probably heard of them, the ICMM. We're one of 26 mining company members of that, and we participate in their initiatives through their climate change working group, and also they have an initiative for cleaner, safer vehicles. They're committed to, or collectively we're committed to net zero by 2050, but also getting zero emission vehicles, I guess, to the market by 2030 and widely adopted by 2040 is I guess, their key target. And trying to reduce some of those bottlenecks along that journey is their focus. They also facilitate vendor engagement, like collectively, so they go out and screen vendors, bring them in and introduce them to our company members and give a platform for them to pitch their technology innovations to us, which is really helpful for a mid-tier like us. We wouldn't probably have the opportunity to see some of those if we weren't a member of that group.
John, I might pull you up there just in the interest of time. We've got a countdown happening in front of us now.
Right.
We've still got to keep it to time notwithstanding, but we'll keep it moving. Thank you, the terrific responses. Look, if we're to achieve the pace necessary to meet mid-century net zero, then we need to see a real acceleration of first-of-a-kind technologies, and they need to follow a pathway perhaps that's very different to the past. Stuart, this is your space. There are some very hard-to-abate sectors like steel, and I think we all noted with interest your involvement in direct reduced iron, the use of hydrogen 20-some years ago. And I also, in looking at your website in more detail the other day, Metso Outotec is doing some really good DRI leadership at the moment. So how do we accelerate, the more general question though, how do we accelerate and commercialise game-changing, first-of-a-kind technology and at that more challenging end of the spectrum?
Yeah, it's this is the $64 million question in a way, but if I just sort of step back, we're a Mets sector business, so we sort of have a very strong technology view. And, if we look at the challenges that are with the industry at the moment, I mean, broadly speaking, there's the supply challenge because the demand is going to ramp up quite heavily for critical minerals, battery metals, for example. And I think that space is not clearly understood yet about how much we do actually have to bring online to meet that demand. But then the other area, which I think is interesting, is there's the process disruption. So you mentioned the steel value chain, which is probably the hardest one to abate in a way, given it's one of the largest emitters as a sector, and plus the process is, basically a carbon-based process. So how do you sort of decarbonise that industry? This is basically requiring a complete, disruption in the steel industry to move away from integrated steel plants or blast furnaces, and there's a lot of solutions that are on the table, but the issue is that they're all first of its kind, and there's nothing really commercialised available. So as an industry, how do you come together and bring something on within the next 25 years to start having a chance to really pull those emission levels back substantially or significantly? So this, in a way, it's quite different to other commodities. In the steel business, I think it definitely requires a much more of a broader collaboration between government, all parts of the value chain. There's good examples where that's happened, like the ULCOS program in Europe, which was very much about the industry and the EU coming together to look at what the options are there. We were involved 20 years ago, a bit over 20 years, in Circa-Red process, which is a pure hydrogen-based direct reduction. It was the commercial drivers were completely not related to climate change at the time, but what's interesting is that it's now come back as a very relevant driver, and we spent decades trying to commercialise that, but now that these sort of targets are being set globally, like Paris Agreement, for example, that's going to maybe accelerate the commercialisation of that sort of technology. So a company like us, we talk with a lot of users and operators, end users industry, and we look at how do we sort of solve the issue. But it's very difficult to see how we can get the proliferation that's required in the industry in the timeframes that we're talking about. So I'm not going to give a solution here, but hyper collaboration and certainly facilitation of how do we sort of share risk about bringing these new technologies on is going to be really a key topic here. I think the normal commercial model doesn't quite cut it, I would say. Incremental improvements in the abatement curve, yes, but these sort of disruptive changes, that's still, I think, a work in progress in many respects.
We'll come to that shortly in a bit more detail. And Chris, I'll come to you in a moment, but back to you, Greg. What can miners, and still on this theme, what can miners do to encourage and foster these early innovations that often involve participants from other sectors?
Yeah, I mean, I think it's a great question. I do think this notion of having a pathway, that sets horizons, this sense of, asset life that's there at the moment, the extent to which you might access biofuels as an interim solution, but obviously at a cost penalty, whilst you're, and charge on in many respects is it's a funnel for sorting options and narrowing down to understand which bets make the most sense. And I think running those sorts of processes, maybe not at that scale, but within those principles makes tremendous sense to then understand the lead times associated with next options, electrification and followed by that hydrogen, and then partnering up where there's already experience emerging around what it requires to de-risk and what it requires to mature technologies. And I think that just really is really talking about great communication, great partnering, and this learner mindset that sounds intellectual, but the reality is it's actually the key to getting on and having breakthroughs, I think.
Thank you. Okay, Chris, in your work you have good visibility of ESG performance, improvement processes being codified into a company's DNA, like KPIs being applied to mining executives for improved ESG performance. But are you seeing KPIs being set to help drive a more collaborative mindset?
Before I answer that one, can I just chime in on Stuart's thing? We did a lot of number crunching back in the early 2000s through to about 2010 on a program called Energy Efficiency Opportunities, which was partly funded by government and was aimed at commercialising ventures which maybe didn't have the right financial payback on paper.
Yeah.
Maybe it's a chance for one of those to be resurrected and start pushing that. With regards to the ESG targets and KPIs, I'm seeing some KPIs starting to be set, but I wouldn't say they're aimed at increasing collaboration. They're pretty well focused on specific ESG targets. That is obviously creating a problem. As Brooke said, one of the earlier speakers, is that 80-odd% of companies have now got an ESG plan or have pathways in place for greenhouse gas reductions and stuff like that, but there's still a disconnect between the plan and the actual execution, which basically says to me that some of those KPIs have not been rolled out yet. The companies have got the plan together, but nobody's really been allocated some of those KPIs to get moving on. Some companies have, but there are still quite a few companies that it's a plan and there's no real method to execute and accountability put in place. And some of that's because it requires a reorganisational structure around the actual people themselves, I think.
Thanks. Stuart, how does intellectual property work in collaborative approaches? Is it a driver for or a barrier to collaboration?
Yes to both, I think.
Yeah.
Yep.
I thought you might say that.
Yeah.
Unpack it for us.
And look, IP's, a business like Metso Outotec is essentially an IP-based business. So that's sort of, in our way, that's our ore body that the miners would see is where their value lies, and in addition to their people. Look, IP can be a barrier, and I can say, based on how we try to commercialise things today, is a barrier in getting, I would say, timely innovation and working. So particularly where there's a high risk profile associated with the commercialisation. And I think this is probably the crux, and goes back to my earlier comment about if you're trying to bring something disruptive and new into business, how is that risk sharing model going to work? And then, of course, you can talk about IP sharing as well in that model, if there's a sort of a balance sharing of the risk. And certainly that is an ongoing discussion. There's no, I think, single easy answer here, particularly if we want to sort of go to these hard to abate parts of the curve in particular commodities. There may be, and here's a discussion where there needs to be a governmental sort of, sharing of risk, or let's say a societal sharing of risk, if we're getting serious about making very, fast, rapid changes here, because it may be too much for a single business to bear by themselves. And I think that's the problem. Very good ideas, but with very high risk profile, that if you want to get something to market or get it to fail fast so you can move on to the next thing, you need to sort of work out how do you do that, because it will slow down proliferation, because you're risk averse naturally, and you try to do things in a very incremental and considered way. And we know technologies can take decades to commercialise. Here we're looking at some sort of hyper implementation of new technologies in many areas. So that needs to be worked out in more detail. But so I've probably described more of the challenges than giving a sort of a simple answer there at the moment. But
no, that was a good answer. Thank you, Greg. And I'm thinking back to my comment about the merging of the energy and resources sectors now. You come very firmly from the energy sector. What are the key risks a miner needs to be aware of when developing its decarbonisation strategy? And is a broader cross-industry collaboration really necessary to address those risks?
Yeah, I mean, some of the work we've done, you sort of look at the electrification of mining as, you know, a solution, but it's 20 to 50 megawatts of generation capacity you need to create a solution. And if I think about the Pilbara as a region consumes about 3 billion litres of diesel that you are looking to displace. That equates in energy terms to around 9 terawatt hours of power. To create that, you need about 3 gigawatts of renewable generation capacity, probably some firming as well. You know, that's $3 to $4 billion of investment, and you look at some of the earlier speakers talk about land access considerations and so forth. So I think the experience that's being developed in renewables development around how you move through those processes, how you contend with the challenges associated with connections into grid networks, if that's applicable, or you design and build the transmission infrastructure that's needed to then get those green electrons into the sort of charge-on concept that I mentioned. To take one example, to get your head around that, it's big. There's enormous investments, enormous scale, and quite a degree of complexity. So I think accessing the organisations that are down the learning curves in these areas can actually fast-track miners towards their emission reduction targets. And I think that's, in essence, the sweet spot that we're searching for in decarbonisation is, you know, how do you think about energy? Is it OPEX, and can others provide solutions on a turnkey basis? Or is there some hybrid between the two where you risk share? But mostly you're looking about how you crack the nut and accessing that knowledge that's already there, I think, in a number of areas of this value chain to basically de-risk it in a collaborative manner.
Yeah, I think for me, there's also the on-mine collaboration when you're putting in all of that electrical infrastructure, potentially quaternary lines, so on. That massive disruption risk of the going concern that's been making bigger margins than Louis Vuitton. There's a lot of sensitivity around integrating that big role. So I think for me too, on-site there's the huge collaboration task. Let's keep this moving. So I'll come to our last theme, and that's the expanded role mining needs to play in the energy transition of the global economy. So let's go big picture. As I said earlier, big opportunity for the sector, but it will see miners needing to invest and re-enter many of the world's most challenging places, as we heard really well yesterday from former Prime Minister of New Zealand, Helen Clark, beautifully she put it. But companies are entering these very challenging places, lack of regulatory safeguards, poor institutions. In many, there's widespread corruption. So extreme care needs to be taken there, and there's this greater need for widespread societal support for this and local community support. And of course, many have commented, this is all against the backdrop of needing to move at extreme pace now. So how do you, reconcile those two needs? Chris? Let's go with you. This is the one. How important is this concept of shared value between a business and the community in which it operates and with its wider stakeholders? And I really note shared value is by definition a collaborative approach to project development and benefit sharing.
Yeah, it's critical. I was reading the latest Harvard Business Review on the flight over, and they had an article in there on linking ESG essentials with financial performance, and they'd put it out into like 6 steps. The number 4 step was collaborate to avoid trade-offs between profit and societal benefit, which I guess is what you're talking about. And I'll quote from it because my memory's not that good. Collaboration with other stakeholders, whether that's companies, governments, or NGOs, require a new degree of cross-sector trust and collaboration. The game of blaming one another for social or environmental problems will have to give way to a partnership in which everyone endorses a shared agenda. And really that new compact is what we need to build if we want to go as fast as we can. It can be done. I remember I was at the Colorado Oil and Gas Conference in 2014, and you could have knocked me over with a feather when Fred Krupp, the president of the Environmental Defence Fund, sat down at the same table as Anadarko, Duke Energy and Encana and signed off on the latest air pollution controls for Colorado. It can be done, but we need to get all the different players involved on the same page, and everybody needs to realise that if we're going to have disruption like we've had in the past, and a lot of the environmental and the conservative movement is pretty good at stopping stuff, but not so good at pushing it on and moving it forward, we're going to need to shift that around so that everybody gets onto the same agenda. We establish that trust and everybody moves forward with it.
Great. So we know who to send out tomorrow morning if there's a protest to articulate that new compact. But I do love what you said, I do, genuinely. Look, last question to you, John, on this theme. MMG has great experience in developing country context. How are you embracing this concept of shared value in the planning and development of your greenfield projects?
Thanks. Yeah, we've got greenfield experience in Peru, in northwest Queensland, and we've currently got a brownfield expansion in Congo right now at the moment. The concept of shared value isn't that new, but sometimes it's forgotten as that the pace of bringing in new developments online, and it's important that that concept. It's really balancing your own profitability with the needs and values of your governments, your communities, your supply chains, all the other stakeholders. So it's necessary to engage with them early, engage with them regularly, and not just when we want something from them. It needs to be a two-way, open relationship based on trust, and then you're in a better position to truly understand what their values are and how we can work together or collaborate together to help deliver some of that shared value. And yeah, I guess that's at least back to the ERM presentation before about just transition as well. We just need to be more focused on all those ESG aspects and really understand who is impacted and how we can minimise those impacts. And not from our perspective, but in other jurisdictions, there's large pushes to have some of these stakeholders as actually like shareholders or co-developers of assets. It's not something we have done in the past, but in the future, particularly with First Nation groups in various places around the world, I think there'll be a greater push to do that, and that can help, truly deliver some more shared value, I think, too. But yeah.
Thanks, John. Well, we have shaved 10 minutes off our digitally allotted time here, so we're going to give that to you for lunch. But look, it's been my privilege to chair this, and thank you again for being here for this somewhat of a graveyard shift before lunch with the late running of this. But look, just please now join me in thanking our excellent panellists.